have to wonder, what we've heard so far about these investment curves by the U.S. on China. Does it change anything for you on how geopolitics go? And will we continue to see sort of this risk premium over Chinese assets because of the politics?
Thanks, Yvonne, and thanks for having me here. And I think Stephen just mentioned a number of key areas where we are seeing the frictions continue to do, or the tensions continue to be higher. And I think if you take a step back, I don't think this is something new. And we have a framework to think about U.S.-China relations over the past few years. And basically, there are four key domains. Number one, trade. Number two, capital markets. Number three, technology. And number four, geopolitics. And based on the analysis that we have done, we have a proprietary indicator essentially helping us to quantify where we are in the U.S.-China relationships based on equity market pricing. And if you look at that indicator, essentially, we have been hovering at very elevated levels over the past year or so. So I think to your question, I don't think the U.S.-China relations or the tensions are something new to the market, but clearly that will continue to be quite an overhang to equity market investors. And based on the sensitivity that we have done, let's say there's no tension between the two nations, I think the Chinese equity markets in terms of valuations will be much higher than where we are now.
And we've been seeing this kind of slowly but surely, this rally that's taking in the A-share market. In a way, you can kind of shield yourself from the geopolitics and focus more on what we've been seeing in onshore markets where margin debt's picking up. We've seen that one-year highs right now. How much further do you think this A-share rally can go?
We think that there's more upside to come. In fact, I spent quite a bit of time in mainland China over the past month. And to your point, we definitely observed that market sentiment has gradually improved from a low level, right, to begin with. And for all the indicators that you just mentioned, margin trading, new accounts opening, turnover velocity, they all suggest that things are moving to the right direction alongside the economic recovery that we are seeing. So right now, CSI 300, which is our benchmark for A-shares, is trading on about 11.8 times forward earnings, and we are forecasting about 18% growth, EPS growth for this year for A-shares. So that combination suggests that the risk-reward continues to look very good for the Asia market. So we remain overweight A-shares in our regional allocation framework.